Hello, everyone. Okay, welcome. It's an early Monday morning. It's Greg Hopkins, Chief Investment Officer at PSG Asset Management. Thank you for joining the webinar. What I'd like to do is just talk a little bit about the backdrop, the investment backdrop, both locally and globally. And we'll give you a little sense then in terms of how PSG Asset Management is tackling the backdrop or the context that I'll describe, and then we'll just give you a sense in terms of where we're finding opportunities and what we are avoiding. Okay, so I'm just trying to get through the presentation. There we go. So we're just going to go there. We've been on the road for the last week or two and met up with a number of investors. And we often get asked the question is, how do you construct portfolios in the face of what are seemingly very large event risks? And some of these event risks that people that are top of mind are, this concept of state capture, and including sort of an impairment of our institutions, our Treasury and our South African Reserve Bank, which are the backdrop of our investment environment. The second is obviously we're approaching a vote of no confidence. There's an ANC national conference in December. And I think the thing that is on top of most people's minds are the potential sovereign downgrade that might materialize over the course of the next year. And that's a downgrade of our local currency debt to junk status. When we look at these type of events, history has suggested to us that it's actually we think it's not a good sort of strategy to actually make forecasts in terms of what might or might not happen, and then try and bet on the outcome. And if you look back over the last year and you see, that the Brexit scenario, the Brexit vote, I think very few people actually called that one correctly, and then even fewer people called the outcome right. In terms of, most people would have suggested if we had seen what we saw, the markets would have been significantly lower. The second was on the US elections in November. Very few people called a Trump victory, and then most people who called a Trump victory would have suggested the markets would have been quite weak after Donald Trump was elected. And the history has suggested that the opposite often occurs. And the same in South Africa. I think quite few people saw that cabinet reshuffle coming, and the change of our finance minister. And most people would have suggested that they'd known that was the case. They would have suggested that, or believed or forecast that the rand would have been a lot weaker than it is at the moment. So our sense is not to take binary bets. Very difficult to call the outcome, first of all, and then the second is to try and very difficult to try and call what would happen if you get the outcome right. And as a result, and we'll talk about this in a couple of minutes, at PSG Asset Management, we tend not to make these forecasts. What we do try to do is focus on what we call second level thinking. The first level thinking is you'll see an event in front of you, and there's a lot of scary news in the newspapers at the moment. There's a lot of really negative outcomes in South Africa. The tendency would be to get quite pessimistic on the markets and extrapolate the recent past into the future. And we would tend to try not to do that, and rather invert the situation and look at what is potentially in the price. And often when you have these type of scenarios, when there's a lot of negative news and it's very visible and it's been going on for a while, often in many cases the market prices that in, and also tends to extrapolate that into the future and assumes that the situation that we're seeing at the moment is not going to end, i.e. that, in South Africa, for instance, we're going to go potentially down the Zimbabwe route. Would be a natural extrapolation in terms of what we're seeing. Why? Because it has happened before, I guess, in Africa. So taking a bigger picture view and taking a step back, we would generally be more cautious on making those type of extrapolations and making those type of forecasts, because there are a lot of moving parts in these type of scenarios, and it's quite difficult to try and get your mind around all those moving parts, particularly if you're taking big binary bets that actually might not work out. What we conclude on, this is a very difficult environment to make short-term decisions. But though in our sense, it's actually quite a good environment to make long-term decisions. And the market context and what you're seeing in the market has actually resulted in if you wanted to take a longer-term approach, I think there's a lot more clarity in terms of how to construct portfolios. And I'll share that with you in a minute. If you if we just go now to market conditions, this chart shows a very simple. It's a very simple chart. It goes back to 1990, and what it shows is the valuation differential, the dispersion of valuations in the market between the most and the least expensive parts of the market. So what it does, what the line shows is, if you take the 20% of the most expensive stocks in the market, and this is a global index by price to book, and you compare that to the cheapest 20% of the market by price to book, and you do that consistently over time, you'll see, this will be the resulting chart, and you'll see over time you get quite big dispersions in valuations between the most and the least expensive parts of the market. And if you look back in 1999, 2000, I think it was quite obvious in hindsight that there were certain parts of the market that were very expensive, the tech sector. What people don't realize is at that same stage as well, certain parts of the market, these high quality bond-like, often consumer or tech-facing or healthcare-facing companies, were also trading on very high multiples. Companies like Johnson & Johnson and Procter & Gamble with 30, 40, and 50 times earnings. When that situation unraveled, you saw a great rotation out of the more expensive parts of the market into the cheaper parts of the market in the periods from 1999 through 2006. And these cheaper parts of the market, often characterized by more cyclical companies with bigger, larger dispersion of outcomes, outperform significantly over a multi-year time frame. If you fast forward to today, in June of 2017, the dispersion in valuations is almost as large as it was in the dot-com bubble. So the expensive shares in the market are as expensive relative to the cheaper shares in the market as you've seen in over 3 decades. And for us, when we look at this type of scenario, we know where we would be betting. We would be avoiding the more expensive shares, and we would be looking at the cheaper shares where the odds are potentially in your favor to generate significant excess returns in the future. And we look at these type of shares. Some of these shares, as we just mentioned, are more cyclical shares. They have got a little bit more beholden on the global economy and in South African context, in the local economy. And these companies have been shunned because global growth and local growth has been at very low levels. And as a result, that people have tended to try and buy shares that offer more visible growth, that are typically more stable type companies, focusing on consumer companies. If we look at this in the South African context, that dispersion of valuations would be even more extreme, because a lot of those blue chip quality, growth type companies are also rand hedges. And if you're concerned about the country, there's been a natural tendency to actually buy rand hedge shares to protect yourself against a fall in the rand. People see that as an insurance policy against anything happening in this country. And whereas a lot of our local facing companies, our banks, some of our industrial companies, our mid-cap companies, some of our other financial companies are trading at very low valuations because the economy has been in recession. There's been a lot of fear around South Africa. If you look at risk, and this is on a global context as well, if you look at the S&P 500, and what we've done is just overlaid the VIX index, and we've actually just smoothed the VIX index. Now, the VIX index is an indication of the volatility of options on the S&P 500, and it's often called the fear gauge. It gives a sense in terms of how the market is perceiving risk, and that's often in current circumstances, how the market is currently feeling about, for instance, the S&P 500. And you'll see the dark line is the S&P 500, and when the S&P 500 is rising and it gets to high levels, the VIX falls. And a falling VIX is often an indication of complacency, where the market is very relaxed, or participants in the market are very relaxed about the markets. And that's counterintuitive for us. When asset prices rise, we generally get more cautious. The chances of generating excess returns in the future is lower. And one could say that the chances of actually making losses is actually higher. And when the S&P 500 fell back in 2009, you'll see the VIX index actually rose to very high levels. There's a lot of fear in the markets. And that also would be counterintuitive to us. When markets are falling, the chances of buying with a margin of safety, when the odds in your favor, actually rises. So if you fast forward to today as well, in June 2017, you'll see that the VIX is actually making the lowest level it's been since 2000. But if you go back, it's actually the lowest level it's been since the VIX started in 1990. And this is, I guess, this is not a surprise to people who can look at this chart and suggest this is where we've been before. Equity markets have risen, and they've risen in pretty much a straight line over the last 8 years, and that's made people, a lot of market participants, complacent. Now, when we look at high quality, blue chip, growthy type shares, and some of these companies in South Africa would be companies like Naspers and British American Tobacco and Richemont and Aspen and these type of companies, we don't see, even though the underlying business models might be lower risk, we don't see them as low risk investments necessarily. We would be more concerned about them because the valuations of these companies are very high. And when the valuations are high, as I've mentioned, we generally are quite cautious. If we look at, for instance, now going back to what I suggested about not taking binary bets, one of the reasons is to try and work out what potentially is in the price. And when you have periods of fear and uncertainties, specifically or especially over long periods of time, often that bad news is often priced into the market. Now, this is a very simple chart, and it's titled "The Investment Case for Long-Dated Bonds." And what it shows, the black line is our current bond curve, our current sovereign curve. And what we've done is we've made it in real terms. So we've taken off 6% inflation. So the line shows the real rate of interest, the real rate of return or yield in the bond curve, going from medium dated bonds all the way up to long dated bonds. The green line, which says 90%, and that ends at 3.6%, so that's 3.6% real. And what it says, that line shows, going back to 2002, when we started the study, it's over 15 years, how often the bond curve has actually been above or below that green line. And so bond yields, what it suggests is that bond yields have actually been 3.6% real and lower almost or more than 90% of the time since 2002. So the fact that the black line, which is the current line at the long bond, the long dated part of the market, is above that, it's actually probably sitting on around the 96th percentile. So what you can conclude is that bond yields have been lower than they have been at the moment, or let's say the other way around. Bond yields have been higher than they have been at the moment, i.e. bond prices have been lower. Remember, when bond prices are low, yields are high. Bond prices have actually been lower, or bond yields have been higher only 4% of the time since 2002. What it suggests is that the bond market is actually pricing in quite a lot of negative news at the moment. And if you make an assumption, and I know a lot of people would say that's a bold assumption, but if you look forward and you say, if the conditions that have persisted over the last 15 years, i.e. a South African Reserve Bank that remains intact and is credible and independent, and a treasury that remains more or less uncaptured, doesn't have to be the best functioning treasury, but it has to remain more or less uncaptured, then there's a 96% chance that bond yields will be lower than they are at the moment. And when bond yields fall, bond prices rise, and they turn out to be good investments. So the message from us is that in the current situation, there seems to be a lot of negative news priced into our bond market and some of our local cyclical and domestic GDP facing companies. And I'll talk about that in a minute. Okay, let me just quickly talk about our philosophy and process in terms of how we would process this information and generate returns for our investors. We have a simple philosophy which we call our 3M philosophy: moats, management, margin of safety. What we're trying to do is assess the underlying quality of a business, the moat, which is the competitive advantage, the management team. We would like management teams with proven track records that are ethical and transparent, i.e. that are good custodians of our clients' assets. But we want to buy these quality companies at discounts, i.e. with a large margin of safety. And you often get asked the question is, how do you get all of that together, i.e. quality companies trading at a discount? And the secret for us, in terms of our philosophy and our process, is that you typically want to be buying quality when it goes on sale. And quality goes on sale when the market, just for a short, brief point in time, becomes a bit more rational, starts focusing on what's in front of it, what's visible and tangible, and the evidence in front, and ignores that we go through some of these long cycles. And these companies then go on sale. Markets become a bit irrational, and you see forced sellers in the market. if you look at just our philosophy, and I'll just show you, this is the PSG Flexible Fund. It's our largest fund. It actually has just passed through 11 billion rand last week. This chart just shows the dark line, or the dark shaded line below is the cash levels in this fund. The PSG Flexible Fund invests in cash and equities. It's a very flexible mandate. It can go from 0 to 100% in equities. Essentially, when we're finding opportunities on a bottom-up basis, when we're looking around the world, and I'll talk about that in a minute, we'll have very low cash levels, and we'll have high equity levels. But when we run out of opportunities or we can't find them, we are very happy to sit in cash. So if you go back to 07, early 08, late 07, we had almost 35% cash in the fund. We had high levels of cash. And as the markets fell through the great financial crisis, and there was lots of fear and uncertainty, and we found lots of above average quality companies trading at below average prices, we deployed that cash. And we ran out of cash in the first quarter of 2009. The gold line is the price earnings ratio of the market, and the dark line is the price earnings ratio of the fund. And you'll see that the price earnings ratio of the fund has always been lower than the market. Some people would suggest that we value investors, and we'd agree with that. But what we think, whether we would be slightly different, is that we think the companies we buy are at least as good as the average company in the market, or sometimes much better than the average company in the market, but they're traded at discounts. If you look at the recent history, we had record amounts of cash in the fund at 45% going into Nene Gate, and we deployed some of that cash in South African facing assets, as we've seen some sell-off in quite a few securities in South Africa. If you look at the type of companies we've owned in the past, these are some of the high conviction top 10 holdings. Some of them have been very large positions in the fund. Sign-off was at one stage was 10%. Microsoft would have been around 7, 8%. Berkshire Hathaway 8% in the funds. Capitec around 7, 8%. These are companies that over the last 5 years we've managed to buy at very cheap levels, and the average price earnings ratio of these companies is around 10, 11 times. But when you look at them, you'll see that we think that they're significantly above average companies. Microsoft, when we were buying in 2010 and 11, was trading at around an 8 times price earnings multiple, despite having $30 billion of cash in the balance sheet, 1 billion customers, margins of around 60%, and market shares around 90%. And just every now and again, you do get these opportunities. Back then, the market was very fearful about the death of the PC, and the management team weren't covering themselves in glory. If you look at the end result, and just to show that this process does work over the long term, this chart just shows the performance of the fund over different time periods, since inception, 10 years, 5 years, 3 years, 1 year. It shows on the right, in the right column, the performance of the Aussie. And then in the shaded box in the middle there, you'll see that the average cash levels in the fund, and you'll see that the average cash levels in the fund have been around 25, 26%, which means that we've had on average around 75% equities. But despite that, the fund has actually managed to outperform the Aussie with 70%, 75% equities over that period. More striking is over the last 2 years, you'll see we've had around 30% cash in the fund, but the fund has been able to outperform the Aussie by a significant margin, almost 9% to 3.5%. The mandate of this fund is to generate equity-like returns at lower levels of risk, and the performance would suggest that we've actually been able to achieve that mandate. So this is a process, this patient, long-term betting when the markets are fearful and uncertainty, but raising cash when the markets are complacent and market prices are high, has worked very well for investors over long periods of time. Okay, let's have a quick look at our current portfolio positioning. So if you take a broad perspective, we went on a large roadshow in January 2017, and we talked about where we were finding opportunities. What we thought in South Africa at that stage, that some of your high quality blue chip SA equities, these Rand hedge quality companies, we thought were overvalued. And you see that they actually shaded red. Some of the companies have continued to go up, Naspers, British American Tobacco, Richemont. But a large number of quality companies that we saw some of our peer group were investing in, companies like Woolworths, Brait, Remgro, Aspen, MTN, Netcare, Life Healthcare. These companies have actually fallen. Spar is another one. these companies have actually fallen significantly year to date. So in hindsight, the breadth in the market has been driven by a small number of companies, particularly like Naspers. Naspers is up almost 40% year to date, and it's almost 20% of the Aussie. So that's been a very big driver of the Aussie performance. We're still positive on government bonds. Property shares, we are more cautious on. We feel that valuations aren't rewarding investors for what could be a less good outcome given the potential overcapacity in the markets and the local economy. Offshore equities, we've been positive on offshore equities for many, many years, 6 years in fact. We've been investing in offshore equities in our local funds since 2006. So we've had lots of experience as a team. We have one process, one team. We scour the world for the best possible opportunities. And more recently, we've become more cautious on offshore equities. In fact, our global flexible fund, and I'll talk about that in a minute, the cash levels in that fund are sitting at around 30% at the moment. In fact, the highest that we've had, the highest cash levels we've had since the inception of that fund almost 4 years ago. Locally, we're still finding good opportunities in our more cyclical end of the market, mid-caps, some financials, some banks, and I'll share a few of those in a couple of minutes. And we've got large amounts of cash in our funds. Cash is yielding, is actually for the first time in many years, is actually yielding good real returns. 1 year NCDs. NCDs are instruments that banks lend to investors like ourselves to borrow money from ourselves. And bank NCDs, 12-month bank NCDs are trading around 8.3%. And some forecasts of inflation over the next 12 months are that inflation in South Africa could get as low as 4.5%. So you could, at some stage over the next 12 months, if you buy these NCDs now and lock those rates in, you could be getting a 4% real rate from near cash, which is a good outcome for savers, people that need income to meet their needs. So if we look at the portfolio positioning, this is the PSG Flexible Fund. This is our local flexible fund. We have 25%, or at the moment 22%, in offshore equities. This fund can invest between 0 and 25% offshore equities. So we've got a reasonably high offshore equity weighting in the fund. We still are finding some good opportunities, even though the overall investment universe offshore we are getting a little bit more cautious. If you look in our top 10 holdings, you'll see companies like Discovery Holdings, Old Mutual, Brookfield Asset Management, which is a global alternative investment manager. They invest in real assets, infrastructure assets, alternative energy assets, property assets. FirstRand, Glencore, Supergroup, Tongaat, Yahoo Japan, which is a Japanese listed media and internet company, Cisco Systems, and Grindrod. So you'll see there's a let's call it a mixed bag. Some local financials, banks, some local mid-cap companies, Supergroup, Tongaat, Grindrod, and some local financials. Discovery is our largest holding in the fund. It's actually quite a controversial position at the moment. We've had a lot of pushback from investors. It's got a very visible bear case. A lot of people look at the balance sheet and look at the cash flow the current cash that the company is generating and the difference between accounting earnings and cash earnings. And some people have questioned management strategy. They're also investing quite a lot offshore, and the historical track record investing offshore many years ago has been relatively mixed. And as a result, it's very under-owned in institutional portfolios. It very much reminds us of Steinhoff back in 5-6 years ago. It's got a very similar type of investment thesis or characteristics of the investment thesis. But we would look at it differently. We think the company is actually is cheap. We look at the offshore business. We think Vitality, which is what they're selling and partnering with offshore institutions, is one of our best, South Africa's best exports. And we think there's a long runway for them to grow offshore, and their local businesses are very strong. If you look at the segmentation, the sector segmentation, we have a large exposure to industrials and financials, and a lot of those industrials are industrial-facing companies in South Africa, where we think that valuations are low and earnings are low because the economy has been in recession for a long period of time. If we look at the Global Flexible Fund, so this is a very similar, well, it's got a similar mandate, generating equity-like returns at lower levels of risk in the offshore markets. This is a fund that's around R1.5 billion in size. You'll see that we have large amounts of cash in the fund at the moment, 30%. And we're running what we call almost a barbell approach, cheap cyclical type companies and large amounts of cash. We have exposure to materials. Glencore is in this fund, and we've got a Canadian commodity fertilizer company called Mosaic. We have some exposure to global industrials. Our largest exposure is actually to financials. Brookfield Asset Management we talked about earlier. This is a company that's been around for many, many years. It's almost 80 years old. They've got a fantastic infrastructure around the world in terms of they've been in a lot of these markets such as Brazil and emerging markets in the US and countries like that for over 80 years. And they're different to other alternative asset managers in terms of they actually operate the underlying infrastructure assets as well. And what they do is the management have got a very large stake in the business, just under $10 billion. So they're very incentivized to make this work and invest alongside us in many of the businesses that they infrastructure assets that they invest in. Infrastructure assets and real assets have been out of favor for many years in a disinflation environment. They haven't been the best performing asset class. In fact, real assets performance versus financial assets, listed equities and bonds, the relative performance is sitting at 80-year lows. If we do see any inflation in the market, these type of assets typically do very well. So this could be seen as quite a good hedge against a global inflationary outcome. And this is a business that sits on top of these. This is an asset manager that sits on top of these hard assets, real assets, and extracts good fees from owning these assets. If you look at just in terms of the philosophy of PSG Asset Management, what you'll see is that the funds that we construct are often typically quite different from the broader markets and from our peer group and from the benchmark. The chart on the right shows the index, the ALSI index. The grey shaded box is our large caps. Let's call it the sort of brown box of the mid caps, and the light grey box of the small caps. And you'll see, Naspers, Richmond, Billiton, Anglo, British American Director, MTN will dominate that index. If you look at our fund, the PSG Equity Fund, you'll see that many of the positions that we hold are not in the index. We've got a larger weighting towards mid and small cap indexes. And that's what we think is a very good opportunity. If you go back to 2002, the last 15 years, the mid-cap index has actually outperformed the top 40 index by 6 percentage points a year. And that compounds over a long period of time at a very, very high rate. These are opportunity sets where the market, that part of the market is often neglected. And particularly in the current climate where some of these companies like Hudeco and Grindrod and Victor and Tongaat Hulett face South African economy. And they're very neglected at the moment. So our funds often look different from peers, which means that over the short term, you could see some dispersion in value in returns between us and the benchmark and our peer group. But as I've shown earlier, over the longer term, we think this philosophy works. Fishing where other people aren't fishing often creates the best possible opportunities for finding mispriced securities. So in conclusion, we think this is a very difficult environment to construct portfolios over the shorter term. We urge investors not to take binary outcome bets, i.e. taking a bet that we will get downgraded and as a result that it'll be very bad for our bond market and for the rand. That might be the case, but we think that that's a very difficult call to make because there are so many different moving parts when you're actually trying to make that assumption. And for instance, the global backdrop is often more important than the micro backdrop, and that's what we've seen happening in our bond and currency markets at the moment, where the global growth, positive global growth environment has been actually quite favorable for our bond yields and for our currency. We continue to avoid stocks with elevated valuations. We don't see these are low risk opportunities. So locally, that means stocks like Naspers, British American Tobacco, and abroad companies like Tencent. Some of the consumer staple companies like Unilever and Roche in the healthcare sector. These are companies that we typically have stayed away from. We think they that the valuations are high levels. We are finding opportunities in the more cyclical end of the market, companies that are cheaper, often in the commodity space, the energy space, the financial space, where earnings are low and valuations are low. And we think that's the best possible opportunity at the moment for investors to generate above average returns at below average risk. I'm going to leave it there. I think we've just run out of time. Thank you very much for joining us. I hope that you found it informative. And if you've got any questions, please send me an email, give us a shout, or call our distribution team, and they'll answer your questions. Thank you very much.